Hello guys, welcome back. In this video we're going to examine Amazon. Been a little bit of a long time since we last took a look at Amazon and its stock, and it's down about 43% since last year. You will take a look at the max charts here and see that the company has been trending downwards pretty steeply here, and it used to be 37 bucks, now it's sitting at 21 bucks. Sounds like a bargain, but is it really? We need to examine the financials and of course avoid buying at the all-time highs. And as the stock market is going down, these are prime buying opportunities, and so we want to discover which kinds of companies that are behemoths, giants that are doing tremendously well are deserving a buy, because we want to be buying cheaply. It's not only about buying great companies. We already know that Amazon is a great company, but is it cheap enough for us to buy is the question that we're going to be answering in this video. So if we take a look at the stock news here, you will see that there's a little bit of a discussion going on about Amazon being a great company and waiting the stock split or buying before that. We know about these things, but what we need to actually understand is what the company is doing in terms of selling and in terms of profit. So over here you will see that the P ratio of the company is expensive, 51. Now typically we want something near 20 if possible, or less. 51 points to a company that is making profit that is a high multiple of its price, and so we don't like to see that. Now the price to free cash flow ratio is very, very negative here, and this may sound terrible, and in many companies it is, but with Amazon that's not the case, and I will explain exactly what is happening when we take a look at the financial statements in detail, so bear with me. Outstanding shares going up a little bit, but not a ton, 6%. I'm probably okay with this one, even though it's next here. A little bit of a dilution going on. Total liabilities to free cash flow, again, this is negative, and I will tell you why. The revenue growth has been increasing tremendously, the same thing with net income growth and total equity growth. It's only the free cash flow that has been going down, and there is a reason for this one. And the company doesn't have a lot of debt, of course, and still the return on equity is pretty interesting here, 17%. Is very good. It's pretty good return on equity. So even without utilizing a lot of leverage here, net income that the margins that are suppressed, of course, and getting a little bit more suppressed through 2022, as you would expect. Now, I do want to examine what is going on in detail with the company, and you will see some numbers here that are tremendous. 178 billion in revenue to 470 billion in revenue. Absolutely awesome, as you can understand, almost like a threefold increase, maybe even more, I'm not sure. But the net income here is something that is absolutely outrageous. 3 billion to 33 billion, this is an 11-fold increase, as you can understand. The company has been growing its profits tremendously through the years, and these last couple of years have been absolutely amazing for the company in terms of the profit that they generate. And of course I'm salivating when I'm seeing that. But again, I need to be making sure that I'm buying at the right price. So, the total equity of the company from 27 billion to 138. Again, as you can understand, the company is growing their total equity like crazy because they are making tons of money. And look at these retained earnings. They used to have 8 billion back in 2017, and right now they're having close to 86 billion. They have increased their retained earnings by 10 times, pretty much by a multiple of 10. And this is pretty much an accumulation of net income. This is what this account is. It's an account that actually records the net income that the company generates, 86 billion right now. Amazing. Cash flow statement. The net income has been growing as we examined, and look at this net cash provided by operating activities has been increasing as well. Apart from this last year, which it has been going down, but look at this other non-cash item. This is a one-off expense, so it's not going to be happening next year. And when you actually add this back to this number, you're getting a number that is like 60 billion or something of that sort. It's still a loss, but there is also a change in working capital, which is almost more than likely not happening next year as well. You can, of course, examine the report. We have a module here, if you take a look at the SEC filings, in which you can actually read the report and see exactly what happened with the company and why they are actually spending that much in this one-off expenses. But what we want to see, and this is very, very crucial really, the capital expenditures, look at this one, 12 billion to 61 billion. So the company in the last couple of years has been spending 100 billion in capital expenditures. Why? Because they are expanding, they are creating new warehouses, they are expanding through the US. I'm not sure about other companies, but they are expanding. And so this means that they're going to be spending money. And remember, what is free cash flow? Free cash flow is the operating cash flow that gets generated from the operations of the company minus the capital expenditures that the company has to continue growing and continue its operations pretty much. And so if these are increased, which is what Amazon is doing, this number will go down. And this is why you are seeing a very, very negative number here with free cash flow. But you need to actually not examine this one for your stock analysis numbers here, because it's artificially down. It's Amazon that actually makes it go down because they want to expand their operations, they want to expand their business. And so this minus 74 and this minus 19, for example, or this minus 327 plays no role really in my analysis, because I know why Amazon is doing that by examining the cash flow statement here, because the company has been generating insane amounts of free cash flow, and it's only because they have been increasing their capital expenditures here that they are going down. And it's very, very worthwhile noticing 2019 and 2020 here. 16 billion, 17 billion, and 40 here in terms of capital expenditures. Yet, with 40 billion spent in capital expenditures, the company made more free cash flow than in the previous year. Let that sink in for a while. Like, they would have made about what, like 40, 45 over here if they haven't allowed this kind of capital expenditures to happen. But again, this makes a ton of sense for a company because they are growing their sales, they are growing their business. And so it's good to see that they're actually growing with capital expenditures that are increasing. So it's not a bad thing at all. Now, if we take a look at our stock evaluation tool, these kind of capital expenditures are irrelevant to the tool. The tool doesn't actually get affected by this one, which is tremendous, really. It's great to see, because the tool is actually projecting based on revenue, and so revenue is not going to change based on what the company is doing in regards to their operations, to their capital expenditures. It's not affected by that. And so the tool will provide you with exact numbers even for a case like Amazon. It's just that you need to be aware of the fact that the free cash flow is sort of like, you could say, a little bit manipulated because the company is spending a lot in capital expenditures. So bear that in mind and factor that in your decision. The company is growing like crazy. Now, the revenue growth of the company has been 26, 21, 28. Of course, we want to go lower. We don't want to go that high, especially in this current environment, really. So I'm going 10, 12, and 14. And the net income margins have been suppressed for the company, especially in the last, actually the last year was better, but in the previous years it was actually 4%, 5%, 7%. In the last year is actually something that I didn't expect. I thought it would be lower. So I'm still going to go with something like 4, 5, and 6 here. The free cash flow margin, you will see that the company has been near 120 here. It's all over the place because the company has been spending a ton in capital expenditures, and over here is actually negative. Typically, when a company goes back to normal and they spend normal stuff in capital expenditures, they tend to make something like 80, 90, 100, 110%. So I'm going to go 80, 90, and 100 here. And the annual return of 13% is what I typically use. And if we hit calculate, you will see that Amazon, having gone down a lot, it's still expensive. And so the current price is sitting at $2,100. But our low estimates are sitting at like $600 and are high at $1,300. And while I love the company and I love what they are doing and how they are expanding, I just can't see myself buying at this price because it's very high. And when you buy at a high price, this is what happens here. The company's stock goes from $37 to $2,100. And so you want to avoid that. And the best way to avoid that is by buying cheap companies. And the thing is, even if you buy a cheap company and it goes down a lot, you have a lot of cushion is the thing. And so it will more than likely go back up because it's very cheap. And it was cheap to begin with when you bought it. So as you can understand, it got cheaper. And so when things get too cheap, they will eventually go back to normal, revert to their mean. And so this is why I'm actually not buying Amazon right now, although I would love to. I would really, really love to hold some stock. It's expensive for me right now. It has to go down significantly for me to consider this. And even though it's a great company and it's making tons of money, it's expensive because people have flocked in and bought a lot of the stock. And as it goes down, I may consider it. If it goes down significantly more, it could become a buy, maybe near $1,000 or so, if it ever happens, maybe not. But then again, there are other opportunities. So thank you for watching the video. Tell me what you think about Amazon, and I'll see you in the next video. Remember to like and subscribe as well. Thanks for watching again. See you soon. Bye bye, guys.